90% of traders don't know that this is the external price action, and this is the internal one. If you are looking on the internal structure, we have a downtrend, with their valid supply zones that traders sell down from them. But if you're looking on the external price action, so the market as a whole, we see a clear uptrend, with a demand zone on the bottom, demands that are being used for buy setups. These two structures, the internal and external, both play together in confluence, and in this video you're going to see why and how you will increase your setup quality after this video. We have the Nasdaq on the 1-minute chart. This market has currently entered into what it looks to be a downtrend, since we see how the market structure is forming lower highs with lower lows. As you should know by now, especially if you've been following this channel for a while, is that during a downtrend, when the market breaks below the past low, so basically right after forming a new lower low, that's when we have what we call a bearish break of structure. And because this is on the internal price action, we call it an internal bearish break of structure. Now, after any break of structure, but also after trend shifts as well, most of the times we're going to see a pullback. Now, of course, that the pullback on a downtrend is simply just a lower time frame uptrend, which is this small move right here. And this pullback happens mostly to rebalance the liquidity. So let's explain how this actually works. Basically, the sellers are closing their positions after the market went down, because of course they want to take profit, and for each selling position to close, there must be an opposing buy position, and that's simply seen as a pullback to the upside. But this pullback usually ends up on a supply zone, or a resistance level, from where it rejects back down into downtrend continuation. So essentially seen on the market structure, it's there to form a new lower low. And the previous theory applies once again, because we've had a lower low, so meaning that we broke the past low, we now have another internal bearish break of structure. But at some point the market has to enter an uptrend as well, and the first major signal that we might have entered into an uptrend happens when the price manages to break above the past high. Look here, that's a higher high formation, the first one in a while. Now when the market breaks above the past high, that's now called a market structure shift. And because this is on the internal price action, this becomes an internal shift. I'll show you the difference between the internal and external, so we make sure you understand how they both move together in the market. So this is how this market looked like on a simple presentation chart. A simple and straightforward downtrend, with its lower highs and lower lows. Now at some point, this market broke above the past high, forming a higher high. This is what we called being the internal trend shift, from an internal downtrend into an internal uptrend. The external shift would happen only if the market would break above the swing high. It's only after this break that we can say this is an external trend shift. The difference is important because this entire price action on the higher time frames is actually seen more similar to this. So this low time frame price action we see right here is just this price action if we would see it from a higher time frame. And if you pay close attention, this external break is actually the same as this one. The price action is the same, it's just seen on different time frames. This is extremely important to know because it will help in deciding which entry levels are more likely to respect. And based on that, we can also properly adjust the take profit and stop loss targets. So now let's come back into the chart. As I've said before, we've got the internal shift. And if we apply what we've learned before, the external shift would happen only if the market would break this swing high, which based on reading candles alone, it looks like it probably will. So as a recap, this is what we have so far, an internal downtrend, with a break of the past internal high, flipping the internal downtrend into an internal uptrend. Now on internal uptrends, we identify internal demand zones. Since the market usually pulls back into a higher low on uptrends, it's why we might be able to look for a buy-long setup from a demand, with the stop loss below the internal demand. And for the take profit, the simplest way is to target the previous internal high, or there is also the option to target the swing high. Or you can use a dynamic take profit, for example taking profits based on what the market is doing at a certain time. We'll see on the charts how we're going to plan the setup, but I just told you all the options, so you have multiple options to try and see what suits you best. Then if we plan the setup right, and we see an uptrend being formed, the question becomes if the market can break above the swing high, so basically above the external high. In the case where this happens, we confirm the external trend shift into an uptrend. Now the reason this is very important is because, remember what I've said in the beginning, after each significant break, like a break of structure, but also after a market structure shift, the market will often pull back. And since the market recently just reversed into an external uptrend, The pullback is a low time frame downtrend. The point of this pullback is to form a higher low, but a higher low on the swing levels. So this can fill an external demand, from where the same story repeats because the theory is the same. But now the only difference is that we have both trends moving together to the upside, so this can give us a very high-quality buy-long setup. So now let's apply the theory in the charts, because that's what makes the difference. So far, we validated an internal demand, because we have the internal trend shift. And we validate this into an external demand as well, only if we have a break of the past external high that should form the external trend shift. But so far we have this smaller demand, from where we apply the theory, with a buy-long position on the demand. Stop loss below the demand, which is also placed below the internal low. And for the take profit, the first target is right above the current high, but we can target even more. For example, above the external high, especially because the last candles are large bullish candles, so there is a higher probability that we will see a break to the upside rather than a break to the downside. But you can also adjust the take profit as the market is moving, depending on what price action it's forming. For example, if we see that after it fills the demand, which would fill the order, and we get a bounce to the upside. And when it comes to the pullback, it moves into a lower low. That's when we will adjust the take profit lower, so basically moving the take profit down, since there is an increased chance of the market reversing into a downtrend, so it would not make sense to target a higher high. And the other way around, because there can only be two scenarios, where we have pullbacks that fills the demand, bounces to the upside, and then on the pullback, it forms a higher low. In this case, keeping the take profit target higher makes more sense, since the market is still holding an uptrend. So let's see the reality put into action. So far it pulled back into the demand, which opened the buy order, and now we see a bounce to the upside. Bounce that eventually turned into a higher high, so far holding the uptrend. Now the crucial point is where the upcoming pullback will end, so we need patience for now. And we got the bounce, which confirms a higher low, from where the market continues higher, breaking above the past internal high. But it also breaks above the external high, so finally we're in a high time frame uptrend now. Because it confirmed the external uptrend, we can now look for the external demand, which is the same as the internal one, because that's the lowest price level that we've got recently. So we would look for an opportunity to enter with a buy-long setup during a downside pullback, a pullback that's just set to form a higher low on the external level. That happened right here, so we can look for the setup now, and we can actually target a higher high internally. Or why not? We have two positions running at the same time with the same targets, since the stop loss and take profit are logical and make sense of the price structure on both positions. We got the bounce from the external demand, a pullback is followed, and a break of the past high, so right now both trends are aligned, the external trend since we've broken the swing high a couple minutes ago. Then we also have an uptrend on the internal structure, and if you don't understand why, let's explain. So the move that led to the price filling the external demand, this move was actually an internal downtrend. You see that we have lower highs with lower lows, but then when it tried to push lower into another lower low, the market failed to do so, and actually it closed higher, forming an internal higher low, which was then followed with an internal higher high. So this is actually an internal shift from a downtrend into an uptrend. So basically both trends, the internal and external, are bullish. This price action keeps repeating once again, moving it closer to the take profit level, which finally hit, closing both trades in win, because remember that these were actually two trades, they just happened to have the same targets. Now into an FX pair. This is straight down a clear downtrend since we're having formed the lower highs and the lower lows, and they're nicely seen. Super simple to spot it just from the first look. Now on these types of downtrends, the lower highs end up many times on a supply level, as seen in this situation right here, and of course most traders will look to sell the market down from a supply, which is a simple approach that it worked great in this case. The market tried to form a higher low, but it failed to break the past high, and instead it moved lower, so it continued the downtrend fundamentals with another lower low, which broke into bearish structure on this higher time frame, being an external break. So as I've said many times, after a break of structure, a pullback should happen to rebalance the market, and here it has done it. However, this time it didn't move into the supply, having the market rejecting down slightly lower. And this is completely fine, as this will actually happen a lot of times, and it shouldn't be a problem. You're basically missing a setup, but that's still way better than losing one. So that formed a lower high, later followed with a lower low, and with a new lower low during a downtrend, a break of structure forms. Now let's pay close attention here because this gets interesting, as you probably see, because we're looking at the external price action, and the entry zones, meaning the supplies that we've considered, are based on the external price action. But some traders are also looking at the internal one. For example, if you would look inside a lower time frame, there is a supply right here. And after the market moved into the lower low to basically form the break of structure, the market pulls back, but just a bit, moves into another lower low. But then it pushes to the upside very aggressively, you see, with this very large bullish candle. This candle essentially breaks all the previous lower highs. And to understand more clearly what happened, we should zoom into the move that happened right before that extremely large candle. That's around this price level. And here we see a downwards price action with a formed internal supply that actually worked one time here, pushing the market down with also pretty large bearish candles. This just shows the volume the market is having during these entry structures like supply zones, demand zones. They have a lot of orders and stop losses, so it's normal for the market to reject or break aggressively from them. You see, above these supply zones, we've got a lot of stop losses from the sellers, and they will eventually get hit because the market can't just go down forever. But structurally, what's actually the important part is that we've broken above the past lower high, validating an internal market structure shift from an internal downtrend into an internal uptrend, since we've formed now a higher high. But the external trend shift happened only after breaking this level. So structurally, the high time frame trend was still following a downtrend, up until we broke this level. Let's do a quick recap to explain on a simple presentation. So we basically, on that entire price action since the beginning, we've had a downtrend that moved somewhat like this. Then eventually we've got a break of the past high. Now this entire price action can actually be met right here. They're basically the same thing. Lastly, having this downwards price action, which actually is just a pullback to form a higher low. On the actual chart, that's this movement. And during uptrends, we validate demand zones near the past swing lows. And we can use these demand zones for buy setups, or as exit targets from sell setups, since under both scenarios, we're essentially planning to form a higher high and take profit there, or to avoid the higher high because that's where our stop losses should be if we were selling this market. Now let's check up on the chart. I will clean this up a little so it won't confuse us. Now if we apply what I've said before, we would now be looking for a demand zone. And in this price action, it should be here, which is exactly the last candle before this massive impulse to the upside. This being the external or high time frame demand. Now one thing that we did not do before, but we can try now, is moving into a lower time frame to see the internal price action inside the external one. So this is the same market and same level looks like inside the 5 minutes chart. Basically a very bearish price action that is just pulling back in order to gather some more orders from the external demand. Case where we will likely see a bounce on the external price action. However, on the internal it's more interesting because we can see in detail each swing movement. We're into the demand currently, and we're seeing a bounce internally out of the demand. Structurally, we would want a higher low to be formed, so it can later follow with a higher high, which would confirm the uptrend on the internal trend, and it later follow with the external too. So far, we're having a small pullback and a very large bullish candle prints. And actually it follows with some more of these type of candles. Pretty bullish. What that shows is that the market moved into a demand level here from the wick, and it instantly reacted to the upside. Now the thing is, that demand probably was in another time frame, so we missed it, and that's fine, as all of these important moves come with new opportunities to find. The key thing from this move is that we've got a break above this high, and after any significant break, we expect a pullback, which looks like it's happening right now. See the last candles that are increasingly having bearish pressure. Now knowing this, we validate a demand, which is inside the larger time frame demand. Pay close attention to what the market has formed so far. On this recent price action, we have an upwards push, and then formations of lower highs with lower lows. That's an internal downtrend. Now an option here could be to trade this internal downtrend. On downtrends, we look for supply zones, which they are found near the previous internal highs. So we can plan a sell-short setup from here, with the stop loss above the recent high, and the take profit placed right at the top of the internal demand. So we have two confluences that play together. The first one is that we have an internal downtrend, so supply zones are being validated. And the second confluence is the demand from below. So even if the market would respect one demand, or both demands, because they are two, one from the higher time frame, and one from here, even if they would respect, we would already be out with the take profit being hit. Now, of course, the worst scenario is the stop loss being hit from this sell position, and the market moving away from the demand, but in this case, we just took a loss from a good risk-reward setup, so it won't affect that much. Now we just have patience, and respond according to what the market is doing. Here the order gets filled, and it's also close to the stop loss, so we need to take care. With an instant reaction to the downside, as I've said, down from a supply zone, pushing into the demand, which hits the take profit eventually, and it actually moved even lower, invalidating this internal demand, however still being inside the larger time frame demand, so we can't be generally bearish until that demand breaks down as well. But that's not the only confluence it needs to respect. There are a few more, but this should be enough for today. We will continue on another video. And don't forget that we also have premium materials on the link in the description. The goal is to shorten your time span and becoming profitable, with the strict necessary and nothing more.